We're going to go ahead and get started. Welcome, everyone. Thank you for
Morning.
joining us today for our strategic tax planning for businesses. Jim, welcome. Good morning.
Morning, Tom. Morning, everyone.
So, my name's Tom Bayer. I'm in the Indianapolis office of Sikich, and my good friend Jim Brandenburg is in Milwaukee, and we'll be walking you through these slides. So we'll go ahead and get started. A few housekeeping items here that I'd like to go over as we get started. You've got the conference IO link up in front of you. If you'd like to use your phone, that QR code will give you access to that. And then throughout the webinar, we're going to have some codes we'll give you. Those will also be in the chat. So if you happen to miss a code, please look at the chat. And then also you'll see up top in your the handouts, we do have a PDF of the presentation, and we also have a PDF up there to help you through the Sikich IO or the Conference IO app. So you can access that a couple different ways to get your CPE. So anyway, so the first code is not a IRS code section, unfortunately. At least I'm not familiar with it, but maybe Jim, who knows the code section like the back of his hand, probably does. But code 679, code 679. So not to be confused with Tommy Two-Tone's song. So, okay, 679 is the code. All right, and legal disclaimer here. That you can read at your leisure. So let's get into the agenda here. We're going to take you through the background of TCJA. We're going to also take you through what provisions sunset, what do not sunset, or more quote unquote permanent. And permanent has quotes around it because as we know, some of these provisions have been changing as the years progress. So and then we're going to walk you through, the impact of the 24 elections on the TCJA debate, and then Jim will talk you through reconciliation, which is a pretty common practice of recent Congresses in terms of getting tax bills passed. So. And then we'd like to talk through, given all that, talk through possible tax planning opportunities in anticipation of these changes at the end of 2025. Okay. So we're going to kick off with a poll question here before we get started. Jim, would you give that question?
Yeah. Our first poll question here that we've got, it should launch here in a moment. Okay. Again, we just wanted to get started with this. Have you started to do any planning around the upcoming sunset of certain TCJA provisions? Again, our options are yes, we've started to consider the impact of the changes. Next, we are aware of these changes but have not done anything yet. And last, we were not aware of these changes and haven't done anything yet. So if you have a chance to go through and indicate your responses here, it's kind of good to, get a little input on that as we get started here. We'll close that in a minute. It looks like top just a little more than half, 52% here. The middle one, we are aware of these changes but have not done anything yet. 33% for the first one that you've started to consider that, and then 15% that are not aware of it. So thank you for your input on that.
Okay, thank you for that, and that gives us a little background. We're going to go ahead and kick right off here. Jim, why don't you take us through some background of TCJA?
Okay, good. Thanks, Tom, and good morning, everyone, again. Again, the TCJA, or the Tax Cuts and Jobs Act, was one of the most significant tax bills in a generation, really going back to the 1986 Act that some of you may recall with it. It was signed into law by President Trump on December 22nd of 2017. Again, it was a comprehensive piece of tax legislation, brought across the board tax cuts for business and individuals. There was some simplification in there, but also many complications, as I'm sure some of you have encountered. Unfortunately, as Tom mentioned at the outset, many of these TCJA provisions were not permanent. They will unwind next year and revert to the tax law that was in effect prior to the TCJA. So we're going to talk on that here in a little bit. The TCJA was $1.5 trillion in tax relief, again, for individuals and business. And it was passed under what they referred to, and we'll talk on a little bit later too, as reconciliation provision in Congress, some special rules. And the Republicans used that to pass the bill, and Democrats were closed out of the legislative process with it. There's certain requirements that must be followed using reconciliation. And there was a lot of items that they wanted included in the bill, but due to these budget rules, some of the items were not permanent, but instead will only last a few years, 5 to 10 years in most cases, some of these provisions. But that's the best they believed that they could pass at the time. And they thought, well, some of these items down the road that they would enact further legislation to extend some of those provisions. Well, we've moved down that road now. It's hard to imagine here. It's been almost 7 years since this passed. We had COVID in between and all the changes there. We're down the road and we've hit a fork. Are we going to continue with those cuts that were passed? Are they going to expire or something else? And that's what we're going to talk about today here. So what we'd like to do now is go through. These are some of the provisions that, again, these are selected items, but these are some of the provisions that will expire at the end of next year, at the end of 2025, and want to make you aware of these. Again, unless something happens, all these changes will go, and these provisions will change and revert back to what the law was back in 2017. The first is the individual tax rates. The TCJA brought in, it has 7 income tax brackets for individuals with it. 5 of those brackets were lowered under TCJA, again, with the top bracket being dropped to 37% from 39.6%. In addition, some of the income in those brackets was reduced. For instance, the last point here, for married filing jointly, the TCJA put the 37% rate would apply at the taxable income over $600,000 instead of $470,000. So again, lower tax brackets and lower income in many cases with it. Next slide. And this next slide here, what this shows is just a kind of comparison of TCJA before in 2017 and then 2018 with the cuts that went through. And we've got a married filing jointly with it. And just comparing the 2 years, and we just put different taxable income levels from $50,000 up to $1 million. And you can see the percentage decrease that went through, in 2018 with these cuts. And again, what will happen is with these cuts, the rates will go back to what they were in 2017. So the reverse of this is scheduled to happen then in 2026. So you'll see increases again across the board for individuals. Now, those brackets are indexed for inflation, so it may not be exactly what this is, but you get the general sense of what will happen when we get to 2026 without congressional action. Next. Another key part of this TCJA, many of you may be familiar with, is the 20% qualified business income deduction, or QBI, or Section 199A. Again, they gave this 20% deduction for businesses, certain businesses that are S corporations, partnerships, or even sole proprietorships. It had many complexities with it. We're still, unpacking some of the changes with this QBI, but it did lower the effective rate for those businesses that operate as a pass-through business. It dropped the effective rate instead of from 37% down to 29.6%, again with that 20% reduction. What will happen, though, again, if this TCJA sunsets at the end of next year, is the top rate will actually jump up to 39.6. So not only do you lose the 20% deduction, but the top rate goes from 37% up to 39.6. So you can see that's a significant rise from 29.6 up to 39.6. That 10% increase is really about a 33, almost 34% increase in the actual tax liability for a closely held business. Next one is one that is sort of an individual one, but has a business component to it, is the SALT, or state and local tax deduction cap. Prior to the TCJA, individuals could take an itemized deduction for their state and local taxes and their state income taxes, and sales tax in some cases. The TCJA, however, put a $10,000 cap on that SALT. It's called the $10,000 SALT limit. Again, in fact, it caused many taxpayers to take the standard deduction and opt to take that instead of the itemized just because of this limit. What happened, though, over the last number of years is a number of states, in fact, almost every state now, has what they call a pass-through entity election, where with a business, they can deduct that state income tax at the entity level and get a deduction for it. And this would be for partnership or S corporation, and actually get a benefit for their state taxes. This IRS notice 2020-75 explains that. Again, most states have it. It varies a little bit by state, but that's been a significant one that allows at least some businesses to get a deduction for their state taxes over the last few years. But again, this has been a controversial provision because, again, some high tax states, are capped out on this $10,000. This item, if this limit goes away, this might, some taxpayers may be relieved when this limit goes away in 2026. So we'll see what happens with that. But that's been a political controversial item in the last few years. Next one, it hasn't got much attention here. This goes back a few years with it. It's this PEAS, it's called the PEAS adjustment. But there was an unusual adjustment that applied before TCJA that actually, I put down here as the tax deduction haircut. It actually took 3% of your itemized deductions that you would have had and took those away. It had the impact of raising your taxes up, though. In fact, if you were in the top bracket, it increased your tax by about 1.2%. So instead of having a top rate of 39.6, it was essentially 40.8% when you factored in this PEAS adjustment. This PEAS adjustment, again, has not applied. TCJA got rid of it. It will come back in 2026. So it's something to be aware of. Next here. This is one of the more significant ones that I think many taxpayers were unfortunately saddled with before TCJ was the alternative minimum tax, or AMT, that many taxpayers were subject to, had to pay the tax, had to go through the complexity. Practitioners weren't necessarily thrilled with it. When the TCJA went through, though, it increased the exemption from $84,000 up to $109,000, and then also increased the point where the AMT exemption is phased out to $1 million. What this did, though, was starting in 2018, many taxpayers who had been in AMT before and paid that AMT tax were not subject to AMT anymore starting in 2018. So fewer taxpayers the last 5-6 years have had AMT. Unfortunately, what's going to happen in 2026, the exemption are going to go back to those lower levels and that lower phase out, and they're going to see many more taxpayers subject to AMT starting in 2026. So this will be one that we'll have to keep our eye on. The additional filing, additional tax, and complexities with the AMT. And then the next one here, and again, this is some estate and gift exemption that was some significant TCJA changes. And I want to just mention at the outset with it, we are going to have another Sikich webinar coming up in about 2 weeks, I think on the 27th, I believe, Tom. But we're going to do some of these other individual provisions and some of the estate and gift with some of our other Sikich colleagues, so you may want to look at that. But we just wanted to mention it here. This was one of the key changes in TCJA. It really doubled the estate and gift exemption starting in 2018, and then those are indexed for inflation. For 2024, that's at $13,610,000 for a person, or again, if you've got a married couple, potentially up to $27 million between them that they have. Again, that's scheduled to cut back in 2026. And again, they will talk about that at their session. So next slide. So again, now we've covered some of the provisions that are scheduled to sunset at the end of 2025. Tom's going to go through now some of the provisions that are, quote, permanent, that are not scheduled to change, that were from TCJA. Tom?
Thanks, Jim. For those of you who may have shown up a little late, you can access the handout section for the slides. Remind everybody the webinar is recorded. And lastly, if you have any questions, please put those in the chat. We'll try to address them, during the presentation, likely at the end. And if we don't get to them, we will address those after the presentation's over. So, please ask any questions that come up as we go along here. So, with that, thank you, Jim, for that summary. Talk about a few things here that don't sunset, right? And in general, a lot of the business provisions are really don't fall into that category of sunsetting, although they have evolved. I would say as the years have passed, as we know, we'll see that in some of these slides. The corporate tax rate, the C Corp rate, really a significant change. Was really done to try to make the U.S. more competitive from a tax rate standpoint with other developed countries. Dropped to 21%. That is not scheduled to sunset. It had been 35% for larger corporations prior to TCJA, but a pretty sharp cut there. And it's remained at 21%, not scheduled to change. Of course, an act of Congress could change that rate, and there has been various proposals out there where they talked about moving that rate up. But as of now, as of current law, that 21% will stay in place beyond the end of 2025. Bonus depreciation is one of those that is somewhat permanent. However, as many of us probably know, it's trending downward by 20% every year. So this year, and as we see at the bottom there, in 2024, we're at a 60% bonus depreciation limit. It started out at 100% when the law was passed, and for several years, and it's starting to scale down. Where in 2027 there will be bonus depreciation is scheduled to be 0%. So that is phasing out, but that the occurrence of 12/31/25 will not sunset that totally, although it continues to phase down every year. So. Section 179 will not expire. And of course, business owners that buy equipment that might qualify, they have to make a decision, and it's a bigger decision now as we see bonus phase down, whether they use Section 179 or whether they use bonus depreciation. The rules are different. So you really have to look at that every year. But Section 179 allows certain property to be expensed. There's a cap on overall additions. That cap went up significantly as a result of the TCJA. So the cap amount increased to $1 million. And the phase out at $2.5 million, right? So and that was in 2018, and that's indexed every year. So if you buy more than $2.5 million of equipment, you start to phase out dollar for dollar of what's eligible for 179. So fast forward to the 2024 year, what are those numbers? Well, the limit stands at $1,220,000, and the phase out threshold starts at $3,050,000, right? So at $3,050,000, you start to lose. If you add more than $3,050,000 of eligible 179 property, you'll start to phase out dollar for dollar and lose that completely at $4,270,000, right? So anyway, so the 179 is not going away, and it will continue to be indexed for inflation every year. Somewhat heavily discussed provision was the R&D expenditures. This is one of the quote unquote pay fors, and many of these that are sort of phasing out, you could look at to say these are really revenue raisers. for the government, right, to lose or deferring deduction. This is one of them. Prior to 2022, these were, research expenses were completely deductible in the year they were incurred. But TCJA changed this, and beginning in 22, you had to amortize them over 5 years. There was some legislative activity to propose to delay the effective date of this change. None of that was ever signed into law, right? So we're currently the law is that you have to capitalize and amortize research expenditures over 5 years, and if it's foreign research, in other words, research that happens, overseas, outside the U.S., that's 15-year amortization. So it's a slower deduction for business owners, and that's permanent. So over time, as we know, that amortization schedule, year 1, year 2, year 3, and as you work through that each year, you'll start to see that deduction come back up because you're going to get more and more amortization expense from prior year research expenses. So, by 2026, you're probably getting a similar deduction that you were when you could expense it immediately. 163J, the interest expense deduction, there's a limitation that TCJA put in place. Pre-TCJA business interest expense was fully deductible, and then TCJA put in this concept of adjusted taxable income, and prior to 20, so I think 2022 was the first year we saw where you had to apply that limitation, 30% of adjusted taxable income. Your business interest expense that was currently deductible is limited to that calculation, right? So, prior to 22, we could add depreciation and amortization to that formula. So that was a much bigger base number. And then after 22 and after, you were limited to basically taxable income, and add back the interest expense to get to this base number that you apply the 30% to. So where does that come into play? If you're highly leveraged and you've got a lot of interest expense, and of course, as we know, interest rates have gone up, you may have a limitation, and that you don't lose the deduction, you just can't use it currently, so it's carried forward. And then businesses with a thin margin, that may have some interest expense, they may find themselves with a limited deduction there. So that again was one of those pay-fors where businesses lose some deduction. I've termed this to be Congress sort of legislating equity versus debt on our balance sheet, and I think, and I've read enough that I think that's a fair characterization of this. So that is permanent. That's not going to change with the sunset of the other provisions. Some other provisions that do not sunset in 2025. We've got the NOL limitation of 80%, so you can only use 80% of the NOL. There was some temporary reprieve. I believe, Jim, I don't want to mischaracterize this. It's 80% of is that 80% of the NOL or 80% of the net income? I think it's 80% of the NOL. Is that right?
80% of the income, but it's for NOLs that are after 2017. Again,
okay.
During the CARES period, there was some relief and some carryback.
Reprieve there. Yeah. Yeah. Right.
If you have a pre TCJA one, then you get 100% on those losses. So.
Okay. Yeah. Thank you. There was some relief on the definition of small business, so you could your small business accounting methods were reformed and simplified, where you could that started at 25 million, and then that's been inflation adjusted since TCJA was passed, And so you can use the cash method on larger businesses than you could pre-TCJA. Like-kind exchanges eliminated the ability to use that concept, that tax code on anything but a real property. That's permanent. That is not set to expire. Entertainment deductions used to be able to take 50% of those. That no longer is the case. That's a permanent change. And then the excess business loss limitation, that also is going to run past 2025, but that doesn't expire until after sort of 2028, and that was extended during some of the CARES bills that moved out to 2028. So that doesn't change with the expiration of that's not a provision that expires. So okay, another code here for those of us that want CPE.
583.
583. So 583, and again, these are, if you happen to miss this, I'm going to step away. These are in the chat, and I don't know, I haven't looked at the handout, but I know there's conference IO materials in the materials section too. So a couple things. International tax was a big issue in the TCJA. Some major changes, really more philosophical on how international activity was taxed in the U.S. So wanted to cover a couple changes, or a couple things that will change once the clock turns over at the end of 2025. So there's really three different regimes, if you will, international tax. There's a GILTI regime, global intangible low taxed income. That's tax on foreign profits. The TCJA made the minimum tax rate between 10.5% and 13.125%. And then the concept of foreign derived intangible income, which was more about export income, that was set at 13.125. So both of those regimes, the tax rate's scheduled to increase to 16.4%. So, okay. And then the BEAT tax, which is base erosion anti-abuse tax, where basically a company can establish management fees and so forth on some of the U.S. income, and it really kind of shifts the profits to a lower tax entity. I can't speak for what there was a recent ruling Coca-Cola had. You might have seen where the IRS has assessed a pretty significant tax because they believe that Coca-Cola improperly pushed profits overseas. That's under appeal. But similar concept here, where companies that do have multinational companies where they're profit shifting. So the BEAT tax is really an alternative minimum tax on income. So you have a separate formula where you have to add back some of these what I'll say is disallowed expenses, and then apply a 10% tax rate. That rate is scheduled to go up to 12.5% at the expiration of TCJA. So, okay. So we've got another poll question. Jim,
Okay.
you want to?
Yeah, our next polling question here. Thanks, Tom, very much. Our second polling question here. How much of an effect do you believe the expiration of these TCJ provisions might have on your business and or your personal tax situation? Okay, we've got significant impact, a modest impact, very little impact, or no impact. So those are your choices here. We've got the all the votes coming in here. Just hold on for a few moments here, and we'll take a look at where the numbers came out. Almost a dead heat here. We've got modest impact at 44% and significant impact at 42%. So pretty close there. Very little impact, 12%, and just 2% no impact. So again, significant or modest impact is what many are forecasting again if this goes through. So thank you very much.
Oh, yeah, sorry about that. I jumped. Okay. So
Okay,
I'm going to turn it over to Jim here to talk about the impact of the elections.
good. Thank you, Tom. Appreciate it. Good update on those provisions. Now that we've looked at those provisions, again, those that will sunset at 2025 and those that will not are not scheduled to sunset, what we're going to look at is um, next year Congress is going to have to deal with this and what tax policy they're going to go ahead with. And a lot of that will depend on what happens in the 2024 elections, both for Congress and the president. And that's going to really impact what happens with the tax legislation next year. So we're going to look at that now a little bit. Um, Again, there's three main outcomes here that you could get. You could have the Republicans could control Congress and the White House. The Democrats could control Congress and the White House, or you could get a split. One party could control Congress or part of Congress, but not the White House. Each of these different outcomes will result in drastically different approaches to what the tax legislation will be. So early in 2025, after, again, the new Congress administration takes over, they'll sit down and begin talks in earnest about legislation. And again, it's probably going to be next summer at this time where it'll get pretty far down the legislative path as far as getting that legislation move forward. What we're going to look at then is what each of these potential outcomes may be as far as what tax policies they may try to push next year. First is, if, as I said, the first one is that the Republicans would have the White House and the Congress. Some of the strategies. First thing they would look to do is the TCJA, the provisions that are set to expire, look to renew those. You know, some were saying this might be TCJA 2.0. Again, they would be looking at keeping the current tax rates in place. I may even see in some cases I've seen where they may want to cut those some. Also keep that 20% QBI deduction. Also retain the estate and gift exemption that we talked about instead of having that get reduced. Corporate tax rate probably stay at 21%. Some say maybe drop it down to 20%. International tax provisions may also get some attention. So a lot of what was in there that didn't get to be permanent, they would look to extend those. Right now, the Republicans control the in the House, and the Ways and Means Committee has actually set up some subcommittees, and they're evaluating different parts of the TCJA already now looking ahead to next year, just to kind of look at some of the issues and what they may try to implement. So they're trying to get a head start with it. The one thing we don't know is, you know, with this TCJA 2.0, whatever, what amount are they going to look to include in there? Again, the last one was 1.5 trillion. Whatever amount they put in there for their bill is what they've got to work within those reconciliation rules to move forward, and that'll be determined next year if we're in that situation. So that's a key part of what those changes will be is how much the bill would have. Next thing we'd look at now is if the flip is if the Democrats would control Congress and the White House, possible strategies with this TCJA sunset. Democrats, there's a couple things that they would look at. Back in 2021, you may recall the Build Back Better legislation that was passed in the House, and there were a number of proposals that were in there. Some of those could get reintroduced in 2025. Those were not adopted in the final bill, but could be brought up again in 2025. The other thing, the resource to look at is what they refer to as the administration or the Treasury Department issues a green book each year on some revenue tax changes or revenue proposals. That came out March 11th this year. Both of those resources may offer some insights on what the Democrats might do if they were in control next year. A couple of those items here, we'll go ahead. This is where some of the items that were in this Build Back Better initially. Again, this bill actually did pass the House, but was held up in the Senate. Higher corporate tax rates increase up to 26% from the 21, raise the individual rate to 40%, might have even a surcharge on higher income, 3 to 5%, higher tax on capital gains and treat that as capital gains and dividends as ordinary income. In some cases apply an income tax on recognized appreciation in stocks. The 3.8%, the net investment tax or the NIT tax apply on all income, even if you're active in the business, if your income is over $400,000. The Section 1202 that Tom's going to talk about later on, that would have been eliminated with this Build Back Better initially. No basis step up at death, and limited use is 1031 like-kind exchange. So those were some of the items that were in the initial House bill that did not make it in there, but some of those could be reintroduced next year. Next slide. Here's some of the items in the, again, this Treasury's Green Book. Higher corporate tax rate, 28%. Again, capital gains and dividend is ordinary income if your income is over $1 million. Treat transfers of appreciated property by gift or with a gift or at death as being a sale. So trigger that. Appreciation would be triggered as a gain. All pass-through income would have the 3.8% NIT tax, even for active owners. In some cases, for higher income, that NIT tax would be raised to 5%. If you have large retirement accounts, one proposal would increase the required minimum distribution. If you have an IRA or a retirement account over $10 million, 50% of that would be taxed. And then wash sale rules for digital assets would be another proposal. Next slide with it, carried interest. Again, this has been around for a number of years, talked about. That would be not capital gain, but ordinary income. Again, like-kind exchanges would be curbed. This FDII, this foreign-derived intangible income that Tom talked about, would be repealed. GST, again, they may talk on this in our session coming up in 2 weeks, would have a limited duration. Private placement life insurance would be curbed back, but then one change would be to increase the child credit up to from $2,000 to $3,000 and $3,600 for young children under 6, and then even look to make a monthly payment of that child credit. Again, these are some of the proposals that the Democrats may do, again, if they're in control of Congress as well as the White House with it.
Okay, and obviously, one of the possibilities, Jim, is the split, right?
Yeah.
Where one party doesn't control the presidency, and both chambers. So, what's that mean? Well, it means they'll have to negotiate, they'll have to compromise, and if they can't, as we mentioned earlier. There are many significant provisions of TCJA that will simply expire. So the tax rates and those benefits will expire. In some cases, if you're in for example, a high SALT tax state, you may come out better if that provision expires. So generally, and by the way, we generally know what the policy's direction is going to be, right? Build Back Better was out there. We've seen proposals from the Republican side. These policies develop over time. What they are exactly at the time they write the law, we don't know. But generally, we know direction of, as Jim said, wealth tax, increase in tax, increase in, income that's subject to the NIT tax. These are going to be the policies depending on which party controls. So, but in this case, there would be a split, and Democrats, as we know, probably would be okay with most of the TCJA provisions expiring. So, we just witnessed a stalemate. The Tax Relief for American Families and Workers Act really was a negotiated bill where child tax credit was going to be reinstated at higher levels, and some of these business provisions, such as R&D and bonus depreciation, they went back to being able to be expensed. Bonus went back to 100%. That bill was sort of died in the Senate, if you will. So we've already seen this play out to some extent of a split. So Jim put this together. He's really good with his colors, But the top left, right, is red, meaning Trump wins, and then both the House and the Senate go to the Republicans, and then the bottom right is blue, and that's if Harris wins and both chambers go Democrat. There's a 1 or 2 in 8 chance that happens, right? And so if that happens, then of course there's a lot more control over tax policy by that party. It is notable, and Jim and I talked over the weekend about this, and realized that the last four new presidents, right? So Biden in 4 years ago, Trump before him, Obama, and then Bush too, all won, and they carried both chambers, right? So the last four, and we didn't necessarily go back further than that. We'd have had to take our shoes off and do some counting. But if you follow that, what's the likelihood of a sweep in either party? I don't know. If history repeats itself, I'd say it's pretty good. So it's interesting to think about. So lastly, economic conditions are going to have a say in tax policy. If we head into a recession, both parties will want to implement tax policy that helps us dig out of that quicker. This is a slide from the Tax Foundation report that was released earlier this year, and it demonstrates that the two tax policies that have the biggest positive economic effect on our country, bonus depreciation and R&D, right? So investment in technology and research and development, and then investment in equipment.
Mhm.
So look for those to really come back if we feel some economic weakness. And lastly, we have to think beyond the 2024 election cycle and the realities that we have. I was listening to Squawk Box this morning, and there were some talk about Social Security, and there were some survey results that they presented. Social Security is going to be, and Medicare are going to be a topic that's going to get more and more attention here as we move into the next decade, right? Because as we know, lots of studies have been done when the fund will hit a deficit, each of those funds. So in the next 10 years, we know that there's going to have to be some reform there. But in general, the federal government is going to have to deal with deficit and the debt. And so what are some of the things that are kicked around? Well, of course, Social Security just increased the tax wage cap, which is at about 166,000 this year. Broader application of taxes like payroll taxes, NIT taxes, Medicare taxes, right? Tax more income. Increased tax rates on dividends or capital gains, a very, very popular strategy as the highest wealth taxpayers in this country. A lot of their income comes through cap gains or dividends, and it's at a lower rate. So there's a real push by some in Congress to increase the tax rates on those. We've talked about the wealth tax, unrealized gains, and taxing somebody on the appreciation of their wealth every year. There's some question of constitutionality of that. And then certain fringe benefits such as health insurance have been popular to discuss. So several different items here that are on the agenda to help fill that revenue gap. Okay, so I'll let Jim talk. I think it's an important topic to talk about. Historically, this has been in recent history, a very popular strategy called reconciliation.
Thank you, Tom. Appreciate the update here with this. Again, we'll just cover this briefly here, but reconciliation is important because, again, it's a special rule that's used in Congress to enact legislation. And again, you just need simple majorities in both the House and the Senate to pass. Again, the Senate filibuster, which usually requires 60 votes, is not available to stop a bill under reconciliation. But it's confined to certain type of bills, budget bills, a tax bill. And generally, there's only one reconciliation bill that can be adopted per legislative session that Congress has. But again, what you need to do with reconciliation, you need to be in control of the House and the Senate and the White House. Again, if you have a split there, you're not going to use reconciliation. You go what they call general order with it. But that was used with the TCJA, for instance, and or the Build Back Better. They tried to use reconciliation, and actually it became the Inflation Reduction Act. But it's used by both parties. Have used it in recent years. But it's as I put at the top, it's a political power play. One party controls the entire process, let's say with a tax bill, and the other party just sits idly by, and the majority moves along with it. There's a lot of detailed rules they need to follow to get it done, but the majority follows that, and the minority is just left out of the process with it. But they craft the bill in such a way that they'll get all their majority on board to pass the bill and make any changes to get it done with it. And minority party, even if they like some of the items, will be against it just because they're left out of the process. Next slide. After a reconciliation bill is passed, what sometimes happens if it's later determined that there's a fix is needed, a technical correction, you would think that would be easy to get done, that they misdrafted something, get it done. But the minority party that was left out of the process is not willing later to remedy a situation, even if it's minor technical correction. So politicians have long memories when it comes to bill they were left out of the process. You come to them later on and say we needed a fix. That doesn't usually go over too well. If it's a bipartisan bill that both sides work on and they need to fix it, generally that's usually done with less difficulty. And here's a couple examples. I'm not going to go through these each. These are just ones in recent years where reconciliation was used and needed some help with it, and it didn't happen right away. There was one, this 199 with the co-ops, some of you recall, in 2018. It was really disrupting a lot of the egg markets. They needed help with it, and they said, we're not going to change it. Well, they finally realized it was going to have such an impact that the Democrats agreed to fix the co-op rule, but they got some low-income housing credit in return for it. It was a 23-to-1 ratio for the additional relief that they got to get this item changed. So just keep that in mind. Even the Tom mentioned before, this tax relief for American families, we still can't get that done. And again, that's part of it was because it was passed under reconciliation initially. So anyway, reconciliation, if one party controls Congress and the White House, they'll look to pass their tax bill using reconciliation. It's been done before, and that's probably the route that they would go, next year, if that's what the results of the election are. So,
Okay, thanks, Jim. We got one last poll question here.
Okay. Okay, next one. Do you anticipate doing more planning around possible changes that will occur in 2025 or 26 is coming up here? Okay.
So pretty
We've
significant.
got yes, unsure, or no. Looks like a yes is the wide favorite here, almost 76% here and 22% unsure. So again, I think a lot of the planning that you're going to do is going to stem for, again, what may happen here with the, once we find out what happens in the election, that will sort of, as Tom said, steer the general direction as to what some of those changes will be. And what we want to do now with it, to thank you for your response on that poll, is we've looked at the TCA provisions, some that will sunset, some that won't, the potential changes that may come with the elections on it. What you want to start doing is start thinking about some of these things. What changes might you want to start thinking about even leading into next year, even before the elections here, some things that start taking into mind. And we're going to go through some of those now for some of these planning ideas or strategies you can start thinking about now. And again, as next year rolls out, then you can fine tune those. And Tom will start off here with some of these strategies.
Thanks, Jim. So, being aware of some of these policy proposals, right, that come out, and we track them pretty closely is important because we really have to know where we're going. And policy proposals seem to linger around in Congress, over a number of years, and all of a sudden they end up in a tax bill. So So as a business owner, I think one of the things we have to think about is, it seems like the pace of policy change is more often, right? We had 86 Tax Act, and then really 30 years later, essentially, we had the TCJA, and here we are less than 10 years later, and we've got probably another major, inflection point in tax policy. And so I think it's going to happen more often. So first thing is, what's your business going to do in the next 3 to 5 years? I mean, what's the plan? Is there succession? Is there major investments? Is there an exit? I mean, the first thing before we really start thinking about tax strategy, let's apply, what's happening in the business and think about how we might be able to implement some tax strategies in order to minimize the tax effect. Tax is about cash, right? Preserving cash. So if we can time up deductions and income and other events so that we can mitigate the tax impact, that's really an ideal situation. But so first thing is to do some modeling. Secondly, I think we got to think about choice of entity. We have a lot of business owners that are entrepreneurial and they're starting new businesses all the time or investing in new, and of course they've got existing businesses. So again, from that modeling, what's going to happen? Are you going to throw off significant losses because you're spending a lot of money on investing in R&D and building up infrastructure and those kinds of things? If you can utilize those losses in your personal return, well, then a pass-through entity might make perfect sense to continue. Alternatively, if you expect growth, if you expect profitable growth, and you're looking to preserve your cash, right? In other words, pay tax at a lower rate, it might make sense to be a C corporation, right? So choice of entity is one of the things that I think we can think about, but I would caution that looking beyond 5 years with the pace of change, and it seems like we're always up against a cliff, I would caution against that.
Mm-hmm.
Section 1202, Jim brought up earlier, it has been targeted. It was targeted as part of the BBB, the Build Back Better proposal. It was in there. Could it go away? Sure. Could C corporation rates increase? Sure. That's basically a law change that the new president would sign into law. But Section 1202, given the fact that C corp is a lower tax entity going forward, especially assuming that that TCJA would expire. There's this provision in the tax code that allows owners of C corps that meet certain criteria to potentially eliminate most, if not all, of their gain on the sale of that stock from tax, right? And if you look at the history of 1202, they started it back in I think 93, and every time a sort of economic downturn happened, they sweetened the benefit of it a little more, and then really since 2011, if you own what's called qualified small business stock under 1202, you can avoid tax on the gain on that stock. And there's a lot of details around it, but it is something to look at given the fact that we may be looking at higher tax brackets on pass-through entities. So the gain, and as I mentioned, the gain on the sale of QSBS stock is eligible for significant capital gain exclusion. One of the major provisions is you have to hold the stock for 5 years. And then the question becomes, if you have an existing business, can you convert, can you get the benefit of 1202, convert your current entity to a C Corp and start that 5-year run? And that's really a question that requires a lot of detail analysis to determine. But know that there's this Section 1202 out here. And as we think about tax planning over the next 5 years, choice of entity and then potentially whether or not you might qualify for Section 1202 might be something to really look hard at. Okay. And the last point too is, remember that C corporations file one return, right? So a pass-through entity, the owners get a K1, and if it's filed in multiple states, there's multiple states that flows through to. So there is one of the small benefits is the simplification of tax filings at a C corp level, and we see that as a benefit as well. So I'll turn it back over to Jim here, and we'll talk about some other planning ideas.
Yeah, thanks, Tom. Great discussion on 1202 and some of the other items. A few other thoughts here. Again, we almost want to get like a counterintuitive situation if we have tax rates potentially going higher than they are right now in 24 and 2025. Instead of accelerating deductions, which normally is the case, we might want to defer some deductions into 2026 if there's a higher tax rate that might apply. For instance, we have an example here of a company that's put some equipment in and some CapEx work of $1 million. And again, they could take the bonus depreciation and some makers and get almost $500,000 of depreciation in 2025. However, if they elect out and take what they call a straight line, they can only take maybe $50,000 in 2025, push off, over $400,000 of depreciation into 2026 and beyond at higher rates. Potentially, if their rate's up 11% higher, they might save $50,000, a permanent benefit, by deferring some deductions instead of accelerating them. So that's one thing that, again, as we get closer to 2025 and knowing what's going to happen between 25 and 26, these are some ideas that you may want to look at. Next slide here, Tom, with it is just overall looking at some of your accounting methods. What you have as far as, again, you may want to look at changing, maybe it's from a cash to accrual or accrual to method to defer some of, have some of that, again, some of the benefit tax that maybe where the rates are still lower, you can pick some of that up or push it to where the higher rates. Review the depreciation methods we talked about. LIFO inventory, again, I think is still something to evaluate. Again, if prices are continuing to rise, if you haven't looked at LIFO, again, you may still get a benefit. If tax rates go up, it may even be more beneficial with it. So something to take a look at with it if you haven't, if you got rising prices, to look at LIFO. Next, Tom, is any of your carry forwards that you have. Again, you have some carry forwards that are built up, whether it's an NOL that we talked about, charitable contributions, some of these carryovers. Again, as you roll those forward into 2026, again, those are going to be potentially benefit for you, any credits. Each of those carry forwards, remember, have different carry forward periods and different rules that apply. So just keep those in mind as you move forward with it. Don't lose track of some of those carryovers. And the last one that we've got here is just some compensation and benefit planning. If you've got a deferred comp plan, look at that. There's 409A rules that you've got to consider, but when you might be able to get that paid out. You might be able to get that paid out maybe at a lower tax rate, or if rates go higher, before those higher rates take effect. Look at some retirement plans, profit sharing, cash balance plans can provide some significant benefit out there. Defined benefit plans, again, if tax rates are up, some of these plans may provide some additional tax savings just because of the higher tax rates. Fringe benefits as well. If you got some fringe benefits, again, to the extent you can take advantage of that, rates are higher, you're actually saving some more with some of those compared to taxable compensation. So a couple things just to keep in mind. Compensation and benefits are always something too, but with tax rates going potentially higher, both the company as well as the individual could benefit with some of those. And again, those would be ones that we fine tune as we move into 2025 and seeing what actual changes are coming down the pipeline. And the last one I would just mention, and we won't get into too much, I know we're getting to the end of the hour here with it. We just put these more for your reference. We're not necessarily going to go through this. Here's our last code word, CPE 371. So we'll put that in the chat, 371 with it. But these charts here, what we really put in is kind of looking at kind of the rates in 2024, 25 compared to 26. Again, looking at the top rate, whether they have the QBI applies or not, whether the NIT tax applies or not. So you can kind of look at situations where you're at now, potentially where you'll be at 2026 if those rates sunsets. We had 4 situations with taxpayers we put in there, and to show what the potential increase you'd be looking at, between 25 and 26 with it, if those rates sunset with it. So we put those in here for your reference. And then after these first 4 of them, Tom, we've got a comparison that you can look at here with a pass-through entity and comparing that to a C corporation. Looking at the rates of a pass-through entity, a C corp, if they paid all its income, we have a double tax. What would that rate be? Kind of comparing it again with those 4 taxpayers we had. Looking at that, you can see the impact. But the last 4 slides with it show, okay, what's that change going to be? If all these rates sunset, you can see that the impact of the double tax is not as much. In fact, in some cases, a C corp, even with the double tax, is better than a pass-through entity in some of those 4 situations. So again, we didn't have a chance to go through those, but we want to make those available to you to take a look at those. And again, just to see what the potential impact is if those rates sunset. So
Thank you, Jim.
that's it, Jim.
Yeah, and these are available. These are nice reference slides to look at as you think about tax rates. They are available in the materials. There's a PDF of all the materials. I think the key is you've got 2 years left here before the potential sunset. Use those 2 years wisely. Do some planning and don't wait. So we're out of time, and a couple closing items here. We will get to the questions. I know there's some questions we did not answer today. We will respond to those. So please be patient with us and we'll get back to you. Secondly, complete the survey at the end. Once we leave the webinar, we will have a little survey in order to get CPE credit. You can check out, and please do check out with Conferences.io. And then please know that you should expect to see your CPE certificate within 2 to 3 business days via email. Okay, and the webinar was recorded and will be available for on-demand access after today for you. So thank you very much. Thank you very much, Jim. And
Thank you, Tom. Thank you all for joining us.
Yeah, thank you all for joining us, and thanks to our very talented staff behind the scenes that helped us put this together, and everybody have a great day.
Thank you.